If you have more than $250,000 saved for retirement, the IRS has a set of rules in 2026 that could cost you thousands of dollars. And most people with that kind of savings never see it coming. Not because they did anything wrong, but because the tax system treats retirement savers differently once your account balances cross certain thresholds, and the rules changed again this year. We are talking about required minimum distributions, Medicare premium surcharges, and capital gains traps that quietly push your tax bill higher the moment your savings look comfortable on paper. If you or someone you love has worked hard to build up a nest egg, this video is for you. Stay with me, because by the end, you will know exactly what to watch for, what it costs to ignore it, and the specific steps you can take right now to protect what you have earned. Let us start with the situation most people do not realize they are in. You saved well. You did the right thing. You put money into your 401k or your traditional IRA for decades. You got the tax deduction every year, and now you are in retirement or getting close to it. Here is what nobody told you clearly. That money was never truly all yours to keep. The IRS gave you a deduction when you put it in, and now they want their share when it comes out. The mechanism they use is called a required minimum distribution, or RMD. An RMD is simply the amount the IRS requires you to withdraw from your tax-deferred retirement accounts each year once you reach a certain age. You pay ordinary income tax on every dollar you pull out. In 2026, the age that triggers RMDs is 73. If you turned 73 this year or earlier, you are already required to take these withdrawals. Now here is where the $250,000 threshold becomes important. If your combined retirement account balances sit at $250,000 or more, your required minimum distributions are likely large enough to push you into tax territory that feels unfair. A $250,000 balance in a traditional IRA generates an RMD of roughly $9,000 to $10,000 in the first year, depending on your age and the IRS life expectancy tables. That may not sound alarming on its own, but when you add that to Social Security income, a pension, or investment dividends, your total income can climb into ranges that trigger two other expensive surprises: higher Medicare premiums and taxes on your Social Security benefits. We are going to walk through all of it together. If you are finding this helpful already, please subscribe to this channel and tap the bell icon so you never miss a video. We cover the real deadlines and rule changes that affect seniors, the ones that do not always make the evening news but absolutely affect your wallet. Let us talk about RMDs first, because they are the foundation of everything else. The IRS uses something called the Uniform Lifetime Table to calculate how much you must withdraw each year. The table divides your account balance by a life expectancy factor that shrinks a little every year as you get older. So the older you get, the larger the percentage of your account you must withdraw, even if the market drops and your balance shrinks. If you do not take your full RMD by December 31st of each year, the penalty is steep. The IRS can charge you 25% of the amount you failed to withdraw. On a missed RMD of $10,000, that is a $2,500 penalty, on top of the income tax you still owe on the withdrawal. The penalty used to be 50%, and even though Congress lowered it a few years ago, 25% is still a serious hit. For someone with $250,000 in retirement savings, this means discipline and planning matter more than ever. You cannot ignore the deadline. You cannot wait for a statement to remind you. The IRS will not send you a bill in advance. You are responsible for calculating the correct amount and taking it out on time. Many banks and brokerage firms will calculate your RMD for you and can even set up automatic withdrawals, but you need to ask them to do that. Do not assume it is happening automatically. Here is a real-world example. Imagine a woman named Carol. She is 75 years old and has $300,000 in a traditional IRA. Her life expectancy factor from the IRS table is 24.6. She divides $300,000 by 24.6 and gets an RMD of roughly $12,100. She must withdraw that amount by December 31st. She also receives Social Security of $18,000 a year. Her total income is now about $30,000 before any other sources. Depending on her filing status and deductions, a portion of her Social Security benefit may become taxable. We will get to that in a moment. The point is that her RMD is not optional, and missing it or getting it wrong is expensive. Now let us talk about what happens when your RMD pushes your income into a higher range. The IRS does not just tax your retirement withdrawals at a flat rate. Your withdrawals count as ordinary income, which means they stack on top of everything else you earn and can push you into a higher tax bracket. In 2026, the tax brackets are adjusted for inflation, but the structure is the same. Single filers start paying 22% on income above roughly $47,000. Married couples filing jointly hit that same rate above $94,000. If your RMDs, Social Security, pension, and other income combine to push you past those thresholds, you are paying more tax on every additional dollar than you might expect. If you are enjoying this breakdown, please give this video a thumbs up and leave a comment below. Tell us, are you already taking RMDs, or are you getting close to 73? Your questions help us know what to cover next, and your experience might help someone else watching today. The second major warning for people with larger savings is something called IRMAA. That stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, an extra charge added to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. Medicare Part B is the part that covers doctor visits and outpatient services. In 2026, the standard Part B premium is around $185 per month. But if your income was above $97,000 as a single filer or above $194,000 as a married couple filing jointly, you pay more, significantly more. The surcharge can add anywhere from $65 to over $400 per month per person to your Medicare bill. Here is why this catches people off guard. Medicare does not look at your income from this year. They look at your tax return from 2 years ago. So in 2026, Medicare is using your 2024 income to set your premiums. If you took a large RMD in 2024, sold a piece of property, or had any other spike in income, you may be paying higher Medicare premiums right now without fully understanding why. And if your savings are above $250,000, your RMDs alone may be enough to push you into IRMAA territory year after year. The good news is that you can appeal an IRMAA surcharge if your income has dropped significantly. The form is called the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, SSA 44. If you retired, lost a spouse, or had another major income change since the year Medicare is using to calculate your premium, you can submit that form to the Social Security Administration and ask them to use a more recent year's income instead. You can reach Social Security at 1-800-772-1213. You can also visit your local Social Security office in person. Do not just pay the higher premium without checking whether you qualify for an adjustment. Let us go back to Carol for a moment. If Carol's RMD of $12,000 combined with her Social Security and a small part-time job puts her total 2024 income at $100,000, she would be in IRMAA territory as a single filer. Her Medicare Part B premium could jump from $185 to around $266 per month. Over 12 months, that is an extra $972 she is paying. Over a few years, that adds up to real money. But if Carol retires from that part-time job in 2025 and her income drops, she can file that SSA 44 form and ask Medicare to recalculate. She does not have to wait 2 years for the adjustment to catch up on its own. If you know someone who is approaching retirement or already in it with substantial savings, please share this video with them. Text it, email it, or show it to them directly. These are the kinds of details that protect real money, and most people never hear them explained clearly until it is too late. The third warning for people with over $250,000 in savings involves Social Security taxation. Many people are genuinely surprised to learn that their Social Security benefits can be taxed. The rule works like this. The IRS uses a number called combined income to determine how much of your Social Security benefit is taxable. Combined income is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefit. If your combined income is between $25,000 and $34,000 as a single filer, up to 50% of your Social Security benefit may be taxable. If it exceeds $34,000, up to 85% of your benefit may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. These thresholds have not been updated for inflation since 1983. That means more and more retirees get pulled into Social Security taxation every year simply because of inflation and RMDs, even if their real purchasing power has not increased. If your savings are above $250,000 and you are taking RMDs, there is a good chance your combined income is already above these thresholds. That means up to 85 cents of every dollar of Social Security you receive could be counted as taxable income. You do not lose the benefit, but you do owe tax on a large portion of it, and that tax comes out of your overall income. The fourth issue to understand is something called a qualified charitable distribution, or QCD. This is one of the most powerful tools available to people with large retirement account balances, and it is completely legal and specifically designed for this situation. Here is how it works. If you are 70 and a half or older, you can direct up to $105,000 per year from your IRA directly to a qualified charity. That amount counts toward your RMD for the year, but it does not count as taxable income to you. You never touch the money. It goes straight from your IRA to the charity, and the IRS treats it as if you never received it. For someone in Carol's situation, using a QCD to send $5,000 to her church or a local food bank reduces her taxable income by $5,000. That could keep her below an IRMAA threshold, reduce the taxable portion of her Social Security, and lower her overall tax bill, all at once. The charity benefits, and so does Carol. To use a QCD, you ask your IRA custodian, which is the bank or brokerage that holds your IRA, to send a check directly to the charity. You cannot withdraw the money yourself first and then donate it. The transfer must go directly from your IRA to the qualified organization. Your custodian can walk you through the paperwork. Subscribing to this channel is completely free, and it means you will never miss a video that could save you money. If you have not subscribed yet, please do that now. It takes 2 seconds and it costs you nothing. The fifth piece of this warning involves Roth conversions. A Roth conversion is when you take money from a traditional IRA, pay the income tax on it now, and move it into a Roth IRA. Roth IRAs grow tax-free, and they do not have required minimum distributions during your lifetime. If you have a large traditional IRA balance, converting a portion of it in the years before you reach RMD age, or converting strategically in lower income years, can reduce the size of your future RMDs and the tax bill that comes with them. The key is to convert only as much as keeps you in a manageable tax bracket. If you convert too much in 1 year, you spike your income, trigger IRMAA, and create a bigger tax bill than you planned for. A tax professional or fee-only financial planner can help you map out a multi-year conversion strategy that spreads the tax burden across several years and keeps your income in a range that avoids the Medicare surcharge and minimizes Social Security taxation. This kind of planning is most valuable in the years between retirement and age 73, when you may have lower income and more flexibility. But even after RMDs begin, partial conversions can still make sense depending on your situation. Let us put some real numbers on this. Imagine a 68-year-old man named Robert who has $400,000 in a traditional IRA and has just retired. He is not yet taking Social Security. His income is relatively low this year. If he converts $40,000 to a Roth IRA, he pays income tax on that $40,000 now at a lower rate than he might face later when RMDs kick in and Social Security adds to his income. The remaining balance in his traditional IRA is now smaller, which means his future RMDs will be smaller. Over time, the Roth IRA grows tax-free and passes to his heirs without triggering RMDs. This strategy is not right for everyone, but for people with large balances and a gap between retirement and RMD age, it can save a meaningful amount of money. The sixth area to watch involves state income taxes. Most people focus entirely on federal taxes, and that makes sense because federal tax rates are generally higher. But 32 states also tax retirement income to some degree, including RMD withdrawals. A handful of states offer exemptions or deductions for retirement income, pension income, or Social Security. But if you live in a state that taxes your retirement withdrawals fully, your combined federal and state tax burden on RMDs could be substantial. Check with your state's Department of Revenue or speak with a local tax preparer who knows your state's rules. Do not assume your state treats retirement income the same way the federal government does. We would love to hear from you in the comments. Have you run into any of these tax surprises in your own retirement? Did an unexpected Medicare bill catch you off guard? Your story matters, and sharing it helps others know they are not alone in figuring this out. Now let us talk about what you should actually do. These are the concrete steps, in order. First, find out exactly what your required minimum distribution is for this year. If you have a traditional IRA, 401k, 403b, or similar tax-deferred account, and you are 73 or older, you likely have an RMD this year. Call your bank or brokerage and ask them to calculate it. Ask whether they can set up an automatic withdrawal so you never miss the December 31st deadline. Second, look at your 2024 tax return and check your total income. Compare it to the IRMAA thresholds we discussed, 97,000 for single filers and 194,000 for married couples. If your income was above those numbers, that is why your Medicare premiums may be higher this year. If your income has dropped significantly since then, complete the SSA 44 form and submit it to Social Security to request a premium adjustment. You can download that form by searching for it by name at the Social Security Administration's website, or you can call 1-800-772-1213 and ask them to mail you a copy. Third, calculate your combined income and check whether your Social Security benefit is being taxed. Add your adjusted gross income to any non-taxable interest and half of your Social Security benefit. If that total exceeds $34,000 as a single person or $44,000 as a married couple, up to 85% of your Social Security benefit is likely being included in your taxable income. There is no form to file to avoid this. It is automatic, but knowing it helps you plan distributions and deductions to manage the impact. Fourth, if you are charitably inclined and you are 70 and a half or older, ask your IRA custodian about setting up a qualified charitable distribution. Decide which charities you want to support, confirm they qualify, and have the custodian send the payment directly. This is one of the few legal ways to satisfy your RMD without adding to your taxable income. Fifth, if you are under 73 and have not yet started RMDs, speak with a tax professional about whether a Roth conversion strategy makes sense for your situation. The goal is to convert amounts that keep your income in a lower bracket now, reduce your future RMDs, and avoid triggering IRMAA or higher Social Security taxation down the road. Sixth, do not try to navigate all of this alone. The rules interact with each other in complicated ways. An RMD affects Medicare. Medicare affects your budget. A Roth conversion affects your taxes this year and for years to come. A fee-only financial planner, meaning one who charges a flat fee and does not earn commissions, can help you see the full picture. Your local area agency on aging can point you toward free or low-cost financial counseling in your community. The Elder Care Locator at 1-800-677-1116 can help you find local resources. Your state health insurance assistance program, known as SHIP, offers free, unbiased Medicare counseling and can help you understand IRMAA and your options for appealing it. Let us bring this all together. If you have over $250,000 in retirement savings, the 2026 IRS landscape includes 6 specific risks to your financial security. Required minimum distributions are mandatory, taxable, and penalized at 25% if missed. IRMAA surcharges can add hundreds of dollars per month to your Medicare bill if your income crosses certain thresholds. Social Security taxation can make up to 85% of your benefit count as taxable income once your combined income exceeds $34,000 as a single filer. Qualified charitable distributions give you a legal way to satisfy your RMD without triggering income tax. Roth conversions, done carefully, can shrink future RMDs and protect you from bracket creep over time, and state income taxes can layer on top of everything else depending on where you live. None of these rules exist to punish you for saving well, but they do require attention and action. The people who lose the most money in retirement are not the ones who made bad investments. They are often the ones who simply did not know these rules applied to them until after the deadline passed. Before we close, here is your action list one more time. Call your bank or brokerage this week and confirm your RMD amount and deadline. Look at your 2024 tax return and note your total income. If your Medicare premiums seem high, look into the SSA 44 form. Check your combined income to see how much of your Social Security is being taxed. Ask your IRA custodian about qualified charitable distributions if you give to charity. Talk to a fee-only financial planner about whether a Roth conversion makes sense for your timeline. and contact your state health insurance assistance program for free Medicare guidance. It costs you nothing and could save you a great deal. Thank you so much for spending this time with us today. If this video helped you understand something that felt confusing before, please share it with a friend, a family member, or a neighbor who is in or near retirement. Subscribe to this channel, hit the like button, and leave a comment letting us know what topic you want us to cover next. You have worked too hard for your savings to lose any of it to rules you did not know about. We are glad you are here, and we will keep making videos to help you protect every dollar you have earned.